Welcome to Value Investing Masters, where we try to see the market through the eyes of the greats.
And today we're putting three of the biggest names in tech under the microscope.
Yeah.
Zoom, PayPal, and Adobe.
We're asking a simple question.
Hmm.
What would Warren Buffett and Peter Lynch do?
This should be a great one. We've got the pandemic darling, the fallen fintech giant, and the creative monopoly. Alex, let's start with the company that became a verb during lockdown.
Okay.
Zoom. Ticker ZM. What's the Buffett take?
Ben, for Buffett, this is a quick and decisive pass. It's a textbook example of a business with a weak economic moat. While he'd understand what they do instantly.
Right.
He'd see the walls of their castle are, well, they're made of paper.
That's interesting. You'd think their brand is a moat in itself.
It has brand awareness, but not the kind of loyalty that gives them pricing power. Buffett's ultimate test is, what stops a customer from leaving? For Zoom, the answer is basically nothing. You can switch to a free bundled competitor like Microsoft Teams or Google Meet in under a minute.
Right.
He'd see it as a melting ice cube in a market where $2 trillion companies are happy to give the product away to protect their ecosystems.
So a great popular product doesn't automatically make it a great investment. What about Peter Lynch?
Well,
He's famous for loving simple, understandable businesses.
Lynch would also run for the hills, but he'd focus on different red flags. First, the massive insider selling. For Lynch, when founders and executives are dumping huge amounts of stock,
Oh, wow.
that's a blaring alarm bell.
Can't argue with that.
Then he'd look at the valuation using his favorite metric, the PEG ratio. His analysis would show it's significantly overvalued for a company with slowing growth.
Okay.
He'd label this a classic value trap.
So a unanimous and resounding no on Zoom. A powerful lesson right there. Let's pivot to a very different story.
Let's do it.
The fallen angel. PayPal. Ticker PYPL. The stock has been absolutely crushed. Is this the kind of opportunity the masters look for?
This is exactly the kind of situation they get excited about. For Buffett, PayPal would be a buy. He'd look past the negative headlines and focus on a core business feature he adores.
Which is?
Dramatic the float.
The float. So the cash that users just leave sitting in their PayPal or Venmo accounts?
Precisely. It's over $40 billion of other people's money that PayPal gets to hold and earn interest on.
Wow.
Completely free. It's like running a bank or an insurance company without all the regulatory headaches. That float alone is a multi-billion-dollar-a-year profit engine.
That's a powerful hidden asset. You combine that with a new disciplined CEO who's cutting costs and buying back stock.
Right. You combine that with a new, disciplined CEO who's cutting costs and buying back stock, and Buffett sees a clear path to value. His math would show a significant margin of safety at today's prices.
A Buffett buy is a huge endorsement. Does Lynch agree?
He'd be even more enthusiastic. Lynch would call PayPal a strong buy.
Okay.
He'd classify it as a stalwart with turnaround potential.
His sweet spot.
Exactly. He loves that the stock has gone from a Wall Street darling to a boring, unloved name. He sees the new management, the aggressive share buybacks, and a very reasonable PEG ratio. For Lynch, this isn't a 10-bagger, but he'd see a very high probability of it being a 3 or 4-bagger over the next few years.
A rare and powerful consensus, then. Both legends would be buying PayPal. Okay, let's round this out with the creative software titan.
Yep.
Adobe. Ticker ADBE. We need to set the record straight on this one. What's the corrected take?
Yes, it's crucial to get this right. The updated view on Adobe is more nuanced. The consensus would be
Okay.
a solid hold and a reasonable buy at this price.
So not a wait for a pullback anymore. What changed the analysis?
The valuation, specifically the PEG ratio. The actual data shows Adobe's PEG is around 1.66. For our listeners, the PEG ratio compares a stock's PE to its growth rate. Peter Lynch likes it under 1.5.
Right.
So 1.66 is not a deep bargain, but it's certainly not the major red flag we once thought.
Okay, that makes sense. So starting with Buffett, how does that change his view?
He'd still begin by admiring the business itself. He'd call it a wonderful company with a nearly impenetrable moat. He loves the switching costs. Designers have thousands of hours of muscle memory in Photoshop. It's a toll bridge business.
A toll bridge? I like that. You have to pay the toll to do your job. So if the business is an A+,
Yeah.
what grade does the price get now?
With the corrected data, the price is more like a B or B+. It's fairly valued. Buffett famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price."
Okay.
Adobe now fits that description. There isn't a huge margin of safety, but you're not overpaying for that exceptional quality.
A reasonable deal, not a screaming one. How does the corrected peg of 1.66 change Lynch's mind?
He still adores the sticky subscription model.
Right.
Appreciative. Recurring revenue is a dream for him, and a peg of 1.66, while not a steal, is perfectly acceptable for a high-quality, dominant stalwart like Adobe. He wouldn't be backing up the truck, but he'd see it as a fair price to own a best-in-class company.
So he's not necessarily waiting for a big sale anymore.
Correct. He'd still note that it's heavily owned by institutions, so the explosive 10-bagger days are long gone. But as a core reliable holding in a portfolio,
Yeah.
it now makes sense at this price.
So, to recap our corrected wisdom, Zoom is still a trap to be avoided. PayPal is a clear contrarian opportunity, and Adobe is a world-class business trading at a fair price, making it a solid hold or even a reasonable buy for new money. It really highlights how one key data point can change the entire investment thesis.
It's all about getting the facts right.
Right.
An Azant asset at a fair price is a solid foundation for any long-term portfolio.
Now, here's a question we'd like you to think about. Of the 3 stocks we discussed, which company do you believe has the best chance of surprising the market, either to the upside or the downside, over the next 5 years, and why?